Okay, let's do Clay. Clay is the sole proprietor of Bath and Tile. It's a business that sells all types of bathroom supplies as well as tiles suitable for any room in a house or business. The entity has a 30 September year end and is a registered VAT vendor. So there's VAT involved. Clay has never kept detailed accounting records and only worries about having information available to complete his VAT returns, which are done by his daughter. His daughter also prepares annual financial statements that are required by the SARS. He is looking to expand his business by opening a new branch in Newburgh, a neighbouring city, and is going to approach his bank for additional loan. He knows the bank will require a business plan and financial statements for the 6 months ended 31 March 2018. As his daughter is currently overseas, he has approached you to assist in getting information ready upon a return for the preparation of financial statements to be presented to the bank. You may assume a VAT rate of 14% where applicable on all transactions. You can assume that all purchases and expenses are with other registered VAT vendors unless otherwise indicated. You were presented with the following financial information from the previous financial year ending 30 September 2017. So obviously these balances are all opening balances. Inventory, trade debtors, delivery truck, accumulated depreciation, wara. Good. Then they give you an analysis of the cash receipts for the period 1 October to 31 March. And they give you analysis of cash payments also for the same period of time. And then we have additional information, so let's check what they want from us. Number 1, prepare the general ledger accounts, T accounts, that's what they want from you, T accounts, which will enable Clay's daughter to prepare the gross profit section of the statement of profit or loss and other comprehensive income for the 6 months ended 31 March 2018. Ensure that the ledger accounts are properly labeled and balanced off. Very important that you read all the instructions. Now, we know that gross profit equals sales, cost of sales equals gross profit. Now, sales, we know there are 2 accounts that goes hand in hand where sales is involved, and that is debtors and sales. So probably I will have to use the debtors account in order to derive at the credit sales figure. Cost of sales, we know, is derived out of the inventory account. On the credit side of the inventory account, we have cost of sales. But something that goes hand in hand with inventory is creditors. So probably we will have to do the creditors account. In the B side, they want calculate the amount of VAT owing to or to be refunded from SARS as at the end of March. So as at year end, what is the VAT control balance as at year end? So obviously we want a T account for VAT with the opening balance in so that we can also, as we go along, keep this or bring this account up to date. And then the last one, prepare the journal entry to record the trade-in of the equipment in the beginning of October. Good. So keeping that in mind, we can go back to our question. Let's open up all the T accounts that we think we're going to use. The debtors, the sales, the creditors, the inventory, and then the VAT control account. So if we go back to our opening balances here, inventory opening balance of 352,000 Rand. So inventory opening balance 352,000. Trade debtors opening balance 70,680. So the debtors opening balance 70,680. Delivery truck, we're not going to be worried about that. Not worried about that. Creditors opening balance 67,260. So creditors, we have an opening balance of 67,260. And then our last one, our VAT control balance then, 12,350. We open up a T account, it's a credit balance of 12,350. Right, let's start with the additional information. It is the policy of Vattenfall to maintain a gross profit percentage of 60% on normal sales. So what would our profit formula look like? Our profit formula would look like this: 40 plus 60 equals 100. Good. 60% on normal sales, 60% of our selling price. Most of the sales of Vattenfall are paid in cash, with most being credit cards or electronic fund transfers. Only a selected number of contractors and regular customers are allowed to buy on credit, and they must be approved by claim. Although Clay is very careful in granting credit to his customers, he discovered that a client owing 6840 had left the country and his account needed to be written off. Good, so that's 6840. We know we're going to credit our debtors account. 6840. We do not really mind about the expense account because it's not required from us to show normal expenses, operating expenses anyway, but what we do worry about is the VAT included in that amount. So in our VAT control account, credit losses 6840 divided by 114 times 14 gives us a VAT input of 840 Rand that we can claim on that transaction. Clay buys his bathroom supplies and tiles from 3 main suppliers. Clay does not like being in debt, and other than the purchase of inventory, which he buys on credit, he tries to pay all his other expenses through electronic fund transfers. Now that's a nice question. Why did I put that into the question? Now guys, that means that my creditor account only links with inventory. I only buy inventory items on credit. So therefore that match between inventory and creditors is actually a perfect match. There's no other interest involved other than inventory items. Although Clay has limited accounting knowledge, he's a very astute businessman and is always aware of the amounts owing from debtors and the amounts owing to creditors. He's amazing. He's Superman himself. He was able to advise you that at 31 March 2018, a balance as per the debtors list was equal to an amount of 61,560, and that the amounts according to the creditors list was a total of 60,420. So the closing balance on my debtors account, 61,560, and the closing balance on my creditors account, 60,420. Closing balance, 61,560. Closing balance, 60,420. Due to the large volume of stock in his shop, Clay did not perform a physical stock count on 31 March 2018. Now that's a nice way to tell you that you have to close off the inventory account, and the closing balance is going to be the balancing amount, and that you're going to show in your statement of financial position as inventory on hand. In January 2018, Mr. J, a large contractor from Newburgh, approached Clay to negotiate a large order of bathroom supplies and tiles. He had recently been given a contract to renovate the bathrooms of a large hotel in Newburgh. Clay was hesitant to offer him credit as he did not know him, but simultaneously he did not want to lose the sales transaction because Mr. J was from the same city where he wanted to open up his new shop. Clay decided to grant him a special cash discount of 10% should he do an EFT transfer on the same day that the delivery of the goods take place. An amount of 359,100 Rand was received from Mr. J on the same day that the delivery took place, and this amount was included in cash sales. Okay, that's a long sing-song and dance. If we shall take cash sales proceeds, analysis of cash receipts, cash sales 104,800, we say that 359,100 is already included there. Okay, now let's post cash sales, because cash sales obviously is going to form the biggest component of our sales amount, which we need for our gross profit section of the income statement. So cash sales, I would have debited bank and credited my sales account. But I would have credited my sales account with what? The VAT exclusive amount of sales. Yes. So cash sales, 104,800 divided by 1.14, that gives us 920,000. And then here in our VAT control account, we would have had cash sales, 128,800. And that is the 920,000. Where is that? Multiplied by 14%, or the difference between the 104,800 and the 920,000, 128,800. The cash sales and the credit sales at the end of the day makes up that figure in the account itself of 177,828. Good. Now coming back to this thing here in the question, why then on earth give me that amount if it's already included in cash sales? Guys, because we have to work out at some point of time cost of sales. And cost of sales is based on a normal selling price. And 359,100 was not a normal selling price. That was a special price that Clay has granted to this person. So if we want to work out what the normal selling price was supposed to be, just cancel this highlight. Then we would have taken the 359,100, the amount that we've received, and we would have said, well, okay, take out the discount. So if we want to gross it up to the normal selling price, we're going to divide it by 90%, and that would have been a normal sales proceeds of 399,000 rand. That inclusive, obviously. So if we're going to take out of that, the amount would have been 350,000 rand. Now, if we want to apply our profit formula, we can only apply our profit formula on the 350,000 rand. So let's remember at the stage when we have credit sales, when we have the figure for credit sales available, and we want to convert our total sales figure into a cost of sales figure, that we have to make provision for this little anomaly that took place during the year. In early March 2018, Clay started to upgrade his home, and he took a bathroom sink with a sales invoice price of 2,394. So that's a selling price. What do we have to do if we want to pass an entry? We want to work back to the cost price. So the first thing is to take out the VAT. So the VAT exclusive selling price is 2,100 rand. That's the selling price. So we want to convert that selling price to a cost price by applying our profit formula. Cost equals 40 over 100 of the selling price. So that means then our selling price would have been 2,100 times 40%. And that gives us a total of 840 rand. So if we had to pass a journal entry, what would we have done? We said debit drawings. We would have said credit our inventory account with what? With the cost price of the inventory of 840 rand, and credit that output with what? With a VAT on the 840 rand, which gives us 818 rand. So 840 times 14%. That's 118 rand. So what are we interested in this? Drawings obviously would have been debited with a total of 958. So what are we interested in this question? We're not interested in the drawings part, but we are interested in the inventory of 840. So in our inventory account on the credit side, drawings 840, and we are interested in the VAT output of 118 rand. So in our VAT output account on the credit side, drawings 118 rand. So then we've updated those two accounts. Good, and then they go on. 9 and 10 is all about non-current assets, which hasn't got an impact on the gross profit section of the income statement, although it has an impact on the VAT that we will complete a little bit later on. We also have to do the trading transaction journal, so we will do that separately. If we go back to our statement or summary of receipts and payments, let's complete it now. Received from debtors 405,840. So in our debtors account on the credit side bank, 405,840. We've already dealt with the cash sales. Then cash payments, rent paid. I'm not worried about the rent paid, but I'm worried about the VAT that we can claim on the rent paid. So in our VAT account, the 47,880, we're going to take out the VAT and we're going to divide it by 1.15 times 0.14 to give us the VAT input that we could have claimed of 5,880. Payments to SARS for VAT, 85,410. We credit our bank account and we debit our VAT control account. Here it is, bank, 85,410. Then payments to creditors, 507,870. So we go to our creditors account on the debit side bank, 507,870. Salaries and wages we're not interested in. Debtors checks returned from the bank as insufficient funds. So our entry would have been credit bank and debit debtors with a 4332. So on the debit side of our debtors account, 4332. Other operating expenses, 165,300. I'm not interested in the expense, but I'm definitely interested in the VAT that we could have claimed on that expense. So here, other operating expenses, 165,300 times 14 divided by 140. The VAT input on that amount, 20,300 Rand. Purchase of the new tile cutting machine, 6420. Now don't just go ahead and claim the VAT or claim the VAT on that, because that was part of a trading transaction. So let's park that entry for the moment. When we do the trading transaction, we will work with that figure, and then interest on the loan, that is not subject to that, so there's no VAT implication. So if we go back to our T accounts now, let's see what we have. Can't we now work out credit sales? In our debtors account, we have the opening balance, the RD checks, the amounts received from the bank, credit losses written off, and then our balance at the end of the year. So that means that the balancing figure on the debit side of our debtors account represent our credit sales for the period. Remember, credit sales in our debtors account includes VAT. So what are we going to do? The VAT exclusive amount will go to our sales account. So credit sales would have been the 399,228 divided by 1.14, which gives us total sales of 350,200. The VAT on that amount, so 350,200 times 14%, would have been this credit sales amount of 49,028. I say again, if I add those two amounts together, it gives me my total sales VAT output of 177,828. Right, now we have total sales. And from total sales, we will be able to calculate our cost of sales. Now remember, cost of sales is being, they have the formula to calculate cost of sales on. So if you have our total sales figure, which is 1,270,200, that figure there, the total there. And we say, well, let's take out here the sales which was not subject to our normal gross profit percentage. Remember that special sale. And we said, well, those sales that was not subject to the normal gross profit percentage equals 359,100, the amount that we have received, divided by 1.14, the amount that is now included in the cash sales amount, which was 315,000 Rand. So they said that the proceeds on these special sales was 359,100. We say, well, okay, cash sales, and it's included in the cash sales amount. Cash sales in the sales account is VAT exclusive. So that amount included in the cash sales amount in the income statement would only have been 315,000 after we removed the VAT out of the sales proceeds. So that 315,000 included in that amount of 920,000 was not subject to our normal gross profit percentage. Then we say, okay, well, if we now convert that 315,000, look, that's not subject, it's not included there at all. If we convert that 314,000 or 15,000 Rand worth of sales into a normal selling price, what would the normal selling price have been? And here we've worked it out. We said that represented 90% of the normal selling price, but remember to take out VAT. So that means that 350,000 is the VAT exclusive normal selling price. So we say, okay, we're going to add back then the normal selling price, which is 350,000. So once we have the normal selling prices in total then, that would have been, if everything happened at the correct sales value, oops, there's 1 0 too many. The total sales value would have been 1,305,200. So if we take that 1,305,200 and now we're going to apply our cost formula of 40 divided by 100, we talk apples and apples and not apples and pears. And that would have given us a total cost of sales figure of 522,080. So we take the normal sales, we take out the funnies included. Now, included in the cash sales amount was VAT exclusive sales of 315,000. We received 359, I take out the VAT 315,000. So I take it out of the amount of my total sales. And then I add back what the normal selling price of that 315,000 was supposed to be. And we said, well, that 315,000 equals actually 90% of the normal selling price. So I could have taken that divided by 90% as well, and that would also have given me the 350,000. They say, well, if I have all my sales figures now converted into a normal sales figure, it would have been 1,305,200 and not the actual 1,270,200. So my cost of sales, I can only work out on a normal figure of 1,305,200, and therefore I'm going to apply my profit formula to the 1,305,200 of 40%, which gives us cost of sales of 522,080. So where does cost of sales feature? I debit the cost of sales account in the income statement, the expense account, and I create my inventory account with 522,080. Right, so we're done with debtors, we're done with sales. Let's see how far we got with creditors and inventory. Now, in our creditors account, we had the opening balance, we had the amounts paid to the creditors, and we have the closing balance. So therefore, the balancing figure that we're going to get on the credit side of the creditors account is credit purchases. Now you can ask, but I already have cost of sales, and that is all I need in order to calculate my gross profit. Now, that is true, because if I ask you the income statement only sales cost of sales, it was not necessary to do this. But in the first place, the question told you, ensure that the ledger accounts are properly labeled and balanced off. So the question tells you, you are not allowed to let the account hang in the air. The second thing is we have to update our VAT account. Now, we do not claim VAT on cost of sales because that is not a VATable item. Where is the VATable item? The VATable item is on the purchases. So in order to do our VAT control account, we have to balance off these two accounts in order to derive at the VAT input that we could have claimed on credit purchases. So the balancing figure in our creditors account is then the 501,030. Remember though that creditors include VAT. Inventory does not include VAT. So I cannot take the 501,030 and dump it like is in the inventory account. I first have to take out the VAT. So my accounting entry would have been debit inventory with a VAT exclusive amount of 439,500. Debit my VAT control account with a VAT on that purchases, which was 61,530. 501,030 times 14 divided by 114, and then credit our creditors with a full amount of 501,030. So only the VAT exclusive amount could have been posted here. Now we've worked out the amount that we can claim for purchases in our VAT control account, 61,530, and we can also now balance off this account because the 268,580 will be the value of a closing inventory as per the statement of financial position. Right, this was only that 840 Rand of drawings that I've explained there. I've done that already. So now I'm done with the A part of the question. I'm not 100% done with the B part, and I'm definitely haven't started with the C part. So let's do the additional information 9 and 10. The delivery truck is depreciated on a straight line basis over estimated useful life of 5 years, but that is not a trading transaction, and that depreciation is not subject to VAT, so that is a bit of useless information. Number 10, Mr. Clay advised you that a new tiling cutting machine was purchased at the beginning of October 2017. The dealer accepted a trade-in of Clay's old tile cutting machine, which had a book value of 30,000 Rand when, at the date of the sale, at the time of trade-in. After then, the depreciation for the current year has been provided. And then I say the remainder was paid by EFT on the same date for the new tile cutting machine. The old machine was purchased in 2015 at a cost of 50,000 Rand. Now, if the cost price was 50,000 Rand and I sold it at a book value or carrying value at the date of the trading transaction of 30,000, it must mean that the accumulated depreciation was 50,000. 50 times 20 equals 30,000. So the accumulated depreciation was 20,000 Rand, 50 less 30. The new tile cutting machine had an invoice price of 102,600. Now let's do the easy one first. Let's claim the VAT on the new tile cutting machine. So it is 102,600 divided by 14 multiplied by 14, which gives us a total VAT input that we can claim of 12,600. Now, they tell us that the cost price of the new machine was 102,600 Rand. We had to pay in for the new tile cutting machine an amount here of 60,420 Rand. Purchase of the new tile cutting machine, the amount that we had to pay in, 60,420 Rand. So what does that mean? If the new machine costed 102,600, we had to pay in an additional 60,000 Rand to get that machine, which is worth 102,000. It must mean that we have received for the old tile cutting machine a total of 42,180. Now, obviously, that includes VAT, you agree? So what we have to do is we have to take out the VAT out of that amount. So 42,180 divided by 1.14 gives us the amount that we are entitled on, which is 37,000 Rand. So let's do the trading transaction, the journal entries now. The first thing that we have to do is to take out the cost price of this machine out of our books, and the cost price was 50,000. So we are going to credit equipment at cost with 50,000. Then we're going to debit the accumulated depreciation, the 50,000, less the 30,000, 20,000 in other words. We're going to debit accumulated depreciation with 20,000, and we're going to transfer the carrying value of this asset as at the date of sale, the 30,000, to the asset disposal account. So we're going to debit the asset disposal account with 30,000 Rand. Right. The second part is to record the proceeds on the sale of the asset. And there we've seen that we have received 42,180 Rand for this old asset. So the trade-in creditor owes us an amount of 42,180 Rand for the new asset. We are going to take the portion that belongs to us, the 37,000, to our asset disposal account. So we're going to credit our asset disposal account with 37,000. And the difference between the two is our VAT, which we are going to pay over to the receiver of revenue VAT output, 5,180 Rand. In total, we received the 42,180. Now we have to close off our asset disposal account. The 37,000 is what we received. The carry value at the date of sale was 30,000, so we can, by simple computation, work out that the profit on the sale of this asset was 7,000. Also, if we've done a T account for the asset disposal account, we would have seen that there's a debit lying there of 30,000, there's a credit lying there of 7,000, so we need in our asset disposal account a debit of 7,000 to clean that account out. The counter leg will go to an income account, profit on the disposal of the asset, or gain on the trade-in of 7,000 Rand. Good. Now we're going to record the new machine. The new machine, we know that the cost price of the new machine was 102,600. We've already worked out the VAT, that is 12,600, so we're going to debit the VAT account 12,600, debit the cost account with the VAT exclusive amount of 90,000, and credit the trading creditor with 102,600, the invoice value of the new asset. In our trading creditor, we now have a debit of 42,180. We have a credit of 102,600. So 102,600 less 42,180 give us a net credit balance there of 60,420. So we're going to debit the trading creditor with the outstanding balance of 64,200, and we're going to credit bank with the amount of 64,200. If we check back to our payments, that is then what we have actually paid, 64,200, so I know that my accounting entry is correct. So the only other thing that we have to do now is to pay over the VAT here in our VAT output. The VAT output on the process of equipment, that was the 5180. That 5180 that we have to post there, and then we've posted all the entries in the VAT control account as well. We can balance off the VAT control account. We see that it will end up with a balance. It's going to be a debit balance, so SARS is actually owing us the VAT of 8916. You could have done your VAT account by pluses and minuses like this as well. You would have derived there at the same 8916, but guys, I would strongly recommend a T account because I think it will reduces the number of mistakes that you can make.